Now we will be seeing the next component in the calculation of cost of equity. In the last video we saw cost of equity calculation, risk-free rate of return. In this video we are going to look at the beta, which is next to the risk-free rate plus beta into RM minus RF. That is the formula of CAPM model to calculate cost of equity. Now beta. What is beta in finance? The beta of an investment security, that is a stock, is a measurement of its volatility of return relative to the entire market. It's used as a measure of risks and is an integral part of the capital asset pricing model. A company with higher beta, which means which has a higher or greater the risk and also greater expected return also. So higher the risk and higher the return. The beta coefficient can be interpreted as follows. If beta is equal to 1, then exactly as volatile as the market. If the beta is more than 1, that is 1.5 or 1.2 or 2 or 2.5 like that, then the particular stock is more volatile than the market. Say for example, if the beta is 2, the particular company stock beta is 2 means it can be interpreted as if the market moved 10%, then the particular stocks move 20%, which is more volatility than the market. That means if a market moves 10% high, then the stocks move 20% high than the market. If the beta is less than 1 or more than 0, then it is said to be less volatile than the market. If the beta is 0, that is uncorrelated to the market. If the beta is less than 0, negative means it is called as negative beta, then it is negatively correlated to the market. If the market goes up means the particular stock's return goes down and vice versa. Below is an Excel beta calculator that you can download and use to calculate the beta on your own. If you want to calculate the beta for a particular stocks, the steps can be followed. Obtain the weekly prices of a particular stock. Say for example, if you want to find out the beta for the Tata Motors, then append the weekly prices of the Tata Motors stock. Then append the weekly prices of the market index. In the slides we have given example of S&P 500 index. In Indian market index you can go for Nifty or Sensex. Then calculate the weekly returns of the Tata Motors. Then calculate the weekly returns of the market index. Use the slope functions and select the weekly returns of the market and the stock, each as their own series. The output from the slope function is the beta. This slides depicts the beta calculations. So beta is the important component in the calculation of cost of equity, because beta means a risk. Measuring the risk, that is measuring the volatility of return of a particular stocks when compared with the entire market. whether the particular stock's returns moves along with the market or it moves against the market, or whether the particular stock's volatility is more than the market or less than the market or going along with the market. So to know, the beta is used. Thank you.